Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice raw sugar in New York. The main feature since late February had been the imperfect dark blue highlighted on my daily chart bear channel. That's currently at 1597 to 1847. Now the lower bear channel line had been pretty good, but the upper bear channel line had only the two touches on it. And when tested in late June by a small late May to mid-July rising expanding wedge pattern, well, it gave way relatively quickly, with prices rising up through the previously highlighted stratified congestion levels at 2003, 2047 and 2069 to 2076, peaking at the latter, as well as the descending medium moving average at the time, which was currently now at 1990. It was, as I said 4 weeks ago, and I quote, the general zone between 21 even to 2010 has seemingly a lot on top. And that's the end of the quote. By the way, I also include in this the previously mentioned bright red highlighted April 2020 to date broken uptrend, currently at 1987, and the bright green highlighted August 2022 to date uptrend, currently at 1903. Now these two broken uptrends did not act so much as resistances, but more as nuisances. The subsequent decline fell down to the same old support we saw in late May and early June, and now last week as well, at the significant 21st century 50% absolute Fibonacci line at 1809. Prices have pulled up a little late last week and this week up over the dark blue and very ineffectual upper bear channel line, but have today been capped by, of all things, the nuisance of the bright green broken uptrend. However, this action over early summer has allowed me to draw a new pattern and speculate on two other possible outcomes. Firstly, I've drawn a late February to early July bearish Andrews pitchfork highlighted in purple on my daily chart. I'm hoping this might provide some idea of the recent bearish angle of attack for the future, though I would be happy to finesse this to a shallower bearish shift pitchfork for the same move if it became appropriate. We are at this time below the upper time, currently at 1954, and above the middle time, currently at 1706. Secondly, we have two opportunities ahead. The more immediate one is that in July we are set to have a monthly key reversal. Thus, if prices close on Wednesday, the 31st of July, either over 2031 or under 1830, then we'd be on. Anything in between will be a lesser outside month. Right now we're looking at a lesser outside month pattern here rather than the monthly key reversal. The other proposition is to possibly regard the action since mid-April as a possible double bottom in forming itself. As this implies, this pattern is not complete and we would need to see how the action develops over the next few weeks. Please note, this is a potential for a double bottom, not a potential double bottom. The distinction between those two is very fine, but definite. West Europe white sugar. The market from the middle to end of January had been wading through stratified levels of support and turning them into resistance above. This all changed with a changeover gap in mid-April between 613.40 down to 580.30. That saw prices exit those stratified levels and go in late April and mid-May to form another pattern, a different pattern, a bearish one. This brings me to a point I raised 15 weeks ago, and I quote, over the last few weeks, I have been voicing a question here that I have been posing to myself. It is this. Is the action since early December last year, is it developing into a double bottom or some sort of wedge or triangle pattern? Last week it was still too early to tell, so that's many weeks ago. Last week was too early to tell, but I am more confident now that the late December 2023 today action is perhaps a possible descending triangle. I've outlined the triangle on my daily chart in bright red, currently at 630 to 626.30. This is a pattern to watch just in case it morphs into something else." End of quote. I also added the following 13 weeks ago, and I quote, "Now that we are here, it would seem appropriate to set out some potentials below for the possible and somewhat short-lived descending triangle pattern. Thus, a primary target X for such a pattern would be down in the 544.80 zone, whilst the harder secondary target X1 would be down in the 497.60 zone." End of quote. 11 weeks ago, prices moved down and reached the primary target X, leaving just the harder to reach secondary target X1 down at 497.60. So, after the first bear flag, after the breakout of that triangle, the market formed a small bull channel between mid-May to late June, perhaps with intent to maybe make another bear flag. However, this did not happen, as at the end of June, the market took a move higher, which was swiftly battered down by the underside of the bright red trend line of the descending triangle, and have been moving lower ever since, more or less into new low territory last week, not seen since October 2022. All this action has, much like New York sugar, allowed me to draw a new pattern and speculate on two other possible outcomes. Firstly, I've drawn a start of April to start of July bearish Andrews pitchfork, highlighted in purple on my daily chart, hoping this might provide some definition to the recent bearish angle of attack. I'll also note that I would be happy to finesse this to a shallower bearish shift pitchfork on the same move if it became appropriate. We're at this time below the upper time, currently at 555.50, and above the middle time, currently at 486.30. Secondly, we have two opportunities ahead. The more immediate one is that in July we are set up to have a monthly key reversal. Thus, if prices close on Wednesday the 31st of July either over 598.40 or under 541.70, then we'll be on. Right now, well, we are looking at a monthly key reversal down, though only by a little. The other proposition is to possibly regard the action since late April as a possible double bottom in formation, in creation. As this implies this pattern is not complete, and we would need to see how the action develops over the next few weeks. Please note this is a potential for a double bottom, not a potential double bottom. The distinction, as I said earlier in New York sugar, the distinction between those two is very fine, but definite. If not, well, all the action since mid-April, well, that could otherwise be a large bearish halfway hesitation or some other such pattern which will develop itself shortly. Sugar white premium. I'd previously spoken here some while ago now about a big picture item here seen on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with the lower time currently at 145 even, tested, breached, and possibly on the verge of being broken. 15 weeks ago, the market made a huge combined weekly key reversal down and bearish engulfing pattern. I suspect this was in large part due to London's sugar month changeovers, but it nevertheless still effectively countered the previous week's bullish closing white Mariposa and set the tone for a lower market, though prices took their own sweet time in getting down below the lower time. So now look to the lows of early to mid-October last year, down in the 115 and 3/4 to 116 even zone as the next support, though when they did this back then, it was just above the dark blue lower time, so it may not be as strong as it's seen back then. Overhead, we have two 50% Fibonacci lines. The July 2019 to September 22 move at 131 1/4, and the August 21 to September 22 move at 128 3/4. Now there are further lesser Fibonacci lines below at 107 3/4 and 104 1/2. But I'm not sure how good they are at this time. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.